What is an exchange-traded fund, or ETF as they're called? How is an ETF different than a mutual fund? And what's the better option, mutual fund or an ETF for investing? We'll answer these questions and more on this, the 39th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody. Welcome back. I've taken a couple of weeks off. For those that followed along, we did a podcast a day in the month of January. I called it the 31-day money challenge, and it was a lot of fun, but boy, it was exhausting. And, the whole experience was interesting for me. There were a couple of surprises for me as I went through that process. One, I guess this wasn't so much a surprise, but I was grateful for my family's patience because it took me away a lot. It took, of course, a lot of time to produce. And I'm grateful for my wife's patience and our children, our son and daughter, their patience with me as I kind of locked myself away in the corner of our basement so that I could record a podcast a day. Very thankful, too, to the many folks that came on the show and talked with us about a variety of different issues. We had a lot of good guests on the show, and those, I think, turned out to be very popular podcasts, and I'm grateful for them. But, one thing that was surprising to me was how much I learned from, the experience. Having invested for more than 20 years and managed our finances for more than 20 years, and now having blogged at DoughRoller.net since 2007, you think not that you can't learn something, but you'd think by now I'd have seen most everything. And but I learned a couple of new approaches to finances thanks to you. I mean, I got a ton of email and comments on the blog. And a lot of readers would point things out to me in different ways to look at things. And there are a couple that come to mind. One is, and I mentioned this in an earlier episode, but a reader had sent me an article published by Betterment. And in the article, Betterment had argued that really you should not keep your emergency fund in cash. And they argued keeping it in investments, whether at Betterment or somewhere else. And, they understand, of course, that with stock investments and with bonds too, the value of your investments can go down over the short term. But their view was, look, if for every $100 in an emergency fund you need, actually save about $120 or $130. That'll give you some cushion if the value of your investments go down. And then go ahead and just include it in your overall asset allocation in stocks and bonds. And over the long term, you'll do much, much better than sticking your emergency fund in a low-paying savings account. Now, before that, I'm trying to think now, I think 6 to 12 months in cash. Actually, as I think about it, it was closer to 12 months worth of expenses in high-yield savings account. I used Capital One 360 and Ally were the two that I had. And that article, while I didn't agree with it completely, I'm not going to take all of my cash out of my savings account and stick it in investments. It did encourage me to lower the amount of a sort of traditional emergency fund. And so, today, I've got about 2 to 3 months. I'd say actually closer to, 3 months. 3 months of expenses in a savings account. The rest I've gone ahead and invested. And I think for me, that was absolutely the right decision. And that was a good learning experience. I don't think there's one right answer to this question. I think it's going to depend on how secure you think your job is, what kind of cash needs you think you'll have over the upcoming months, and all of that. Also, other debt you have that you're trying to pay down. In our case, we're just down to our mortgage. So, but that was something that forced me to look at an emergency fund a little differently than I had in the past. The other thing that I learned that stands out for me is that I was writing about the different retirement options, 401ks and IRAs, and one reader said, you need to factor in the backdoor Roth. Which I'm going to write about, and I'll have another podcast show just on this topic. But if you're not familiar with it, a backdoor Roth is when you take a traditional IRA, whether you were able to deduct the contributions or not. Typically, I think in many cases, it's situations where you were not able to deduct it because of your income and your retirement accounts at work. But in any event, you then convert it to a Roth IRA, and this has been permitted regardless of your income, I want to say, since 2010. But if you think about it, let's say you can't deduct your IRA contribution, but you go ahead and you open up an IRA. Anyone can open up an IRA regardless of how much you make, as long as you have income that's at least equal to the amount of your contribution. But Warren Buffett could open up an IRA, or LeBron James, I guess whoever your rich person is you have in mind. And they could fund an IRA. Now, they couldn't likely deduct it if their income disqualified them and they had a plan at work. But they could still fund an IRA. And then you convert it to a Roth, and you say, well, what's the point of doing all that? Well, once you convert it to a Roth, then the investment returns that you earn grow tax-free. And you can keep it in there until you retire. And then when you start to use the money, it's tax-free. And there's no required minimum distribution as there is with a 401k or a traditional IRA. And that's something that my wife and I had not taken advantage of. And I kind of kicked myself. We really should have. I think in my case, it's a little more complicated because I have other IRAs, rollover IRA, a SEP IRA, and that makes the conversion to a Roth a little more complicated. I won't dive into that now, but I will when I write about the backdoor Roth here soon. But for my wife, certainly she does not have an IRA. So for her, it's really an absolutely good move to make, and we're going to do that. And I kick myself. It's like, I'm familiar with the backdoor Roth. I read about all this stuff, but somehow it just didn't translate into action. And so that was another thing that I was thankful for the reader to bring that up, and it helped me. So, I learned a lot during the 31-Day Money podcast or Money Challenge. I'm glad I did it. I hope you enjoyed it. If you haven't listened to it, you can just go to the site. You'll see a little drop down at the top of the site with a link to the 31-Day Money Challenge. And I've gotten a lot of great feedback from that, so I'm happy I did it. Now, I then took a couple of weeks off, and now we're in the middle of February 2014, if you happen to be listening to this podcast sometime in the future. And it's time to get back in the saddle and get going again. And so today I thought I'd talk about a topic that a number of people emailed me about during January, and that is mutual funds versus ETFs, or exchange-traded funds. What's the difference, and what should we invest in? And so I want to cover that today, and you'll see in the show notes, which will be at DoughRoller.net/podcast 39, you'll see a detailed article about this with some helpful links to Vanguard and Morningstar that you can check out for additional reading. But so let's cover this. So let's start with the basics. So a mutual fund, as I think most people understand, is a very simple and if you do it right, a low-cost way to quickly diversify your investments. You can invest in a mutual fund, and that mutual fund will then take your money and invest in a basket of either stocks or bonds, right? There are stock and bond mutual funds. There are actually mutual funds that also invest in both stocks and bonds. And so what you can do with really very easily and simply, you make one investment in a mutual fund, or maybe you invest in 2 or 3 mutual funds, and they take your money, they diversify it for you by putting a little bit of each dollar into the various stock or bonds that mutual fund invests in, and you're well diversified very easily. During the 31-Day Money Challenge, we talked about of sort of a core portfolio of Vanguard mutual funds, which would include their total stock market mutual fund, which basically covers all U.S. stocks, their total bond market mutual fund, and then their foreign fund. And so with 3 mutual funds, investments in just 3 funds, you would get a great diversity with both stocks and bonds, as well as U.S. stocks and foreign stocks. And that's a mutual fund. And there are, of course, costs associated with a mutual fund, as we talked about, and that's extremely important. You'll see most of the costs are identified in what's called an expense ratio, as we've covered. And my goal across all of my investments is to keep my expense ratio below 25 basis points. That's 0.25%. And I think today I'm at 22 basis points, so that's good. And it's funny. I had a talk with a very good friend. He's a very smart guy. He's an accountant. I've known him for a long time, and he has some money with a large brokerage firm that I won't name, but it's one we've all heard of. And he's paying between management fees and expense ratios 176 basis points. It's 1.76%. So you think about it, just to equal the index, let's say the S&P 500 for his stock investments, he's got to beat the index by 176 basis points. Really impossible as a practical matter over the long term. And so he and I had lunch the other day, and he is working to change all of that. So costs are extremely important. They can zap your investments very quickly. They compound over decades of investing, huge. So mutual funds, the right ones, and I'm a big fan of Vanguard, gives you low-cost investing and very easy diversification. So that's a mutual fund. Okay, so what's an exchange-traded fund or an ETF? Well, at one level, an ETF is very similar to a mutual fund, right? You can, again, invest in just a couple of ETFs, just like mutual funds. They will, your money then gets effectively, it's a little different as we'll see in a minute, but spread over the various investments held by that ETF, and you get immediate diversification. In fact, there are mutual funds and ETFs that cover the exact same investments. I mean, take Vanguard, for example. They have an S&P 500 mutual fund and a virtually identical S&P 500 ETF. They cover the same investments. The performance of the two are virtually identical. And in Vanguard's case, depending on the class of shares you buy in the mutual fund, and we'll talk about that in a minute, the expense ratios are about the same. So, maybe having you wonder, okay, then what's all this fanfare about ETFs, and why do we have them, and do I need to worry about them? Do I need to bother with them? So let's talk about the differences. I'll start out by saying that I don't think most investors need to worry about ETFs, and particularly those that invest like I do in low-cost index funds at companies like Vanguard. And I'll explain why in a minute. But let's cover some of the differences with an ETF versus a mutual fund. So mutual funds do not trade like stocks do. You can see when the market's open, the price of stocks goes up and down throughout the day. If you want to buy a stock, you're not buying it from the company. If you want to buy a share of IBM, you don't call up IBM and say, hey, sell me a share of your company, right? You get with a brokerage account and you buy from another investor who wants to sell. It's the secondary market, effectively. And so you're buying and selling shares of a company with other investors, right? A mutual fund doesn't work that way. If you want to invest in a mutual fund, you don't go to another investor and ask to buy his or her shares in that mutual fund. No, you just go to the mutual fund company. You go to Vanguard, for example, and say, hey, I want to invest in the S&P 500 index fund that you've got there, and here's my money. And they give you shares that correspond with the amount of your investment, and take your money and spread it out over the S&P 500 companies in that fund, or whatever companies that particular mutual fund happens to invest in, or bond fund, whatever it may be. So you're interacting directly with the mutual fund company. And if you want to sell, it's the same thing. You don't sell to another investor. You just call up the mutual fund company or log into their website and hit the sell button, and they cash you out, right? ETFs don't work that way. ETFs trade much like stocks do. Their prices fluctuate throughout the day as the market is open, and if you want to buy a share of an ETF, you buy from another investor. And if you want to sell, you sell to another investor. So what's the significance of that? Well, there are a number of things. First of all, you typically pay a brokerage fee when you buy a share of an ETF, just like you would when you buy a share of a company. With mutual funds, if you're going to buy directly from a mutual fund company, there are generally not brokerage fees involved. There aren't brokerage fees, I should say. So with an ETF, you're paying a brokerage fee. That's one. Two, there's a bid-ask spread with ETF shares, just like there are with buying individual shares of a company. And I don't want to dive too deeply into this issue, but think about it this way. The bid price is what the buyer is willing to pay. The ask price is what the seller is willing to accept. And they're never the same. There's always a gap between the two. And in the case of ETFs, the delta between the bid and ask price is effectively, you can think of it as the fees that what they call the market maker. But in any event, the person in between this transaction keeps. So there's in addition to the brokerage fee that you'll pay, there's a bid-ask spread that effectively represents a fee that you will pay as well. Now, that bid-ask spread can be very, very small, particularly for ETFs that are very actively traded. But the spread can also be quite large if there's perhaps not as much liquidity in that particular ETF. It's not traded as frequently. So that's another expense that you pay. A third difference is that the cost of an ETF is almost never exactly the value of its underlying assets, which is known as the NAV, net asset value. Usually, ETFs trade either for slightly more than the NAV, which would mean it was selling at a premium, or slightly less than the NAV, which would mean it's selling at a discount. It's never rarely exactly equal to the value of the underlying assets. And that can be a cost. Of course, it depends on whether you're buying or selling and whether it's selling at a premium or a discount, right? So in some ways that can work in your favor. In some ways it can work against you. So that's a difference. Now, that all sounds negative, right? This all sounds, one, it seems to complicate things, and it does. And it can potentially add some expenses. So you say, well, so if that's the case, then what's all the fanfare about ETFs? Well, there are some potential advantages. One is that ETFs don't have the same operational overhead that a mutual fund does. And as a result, in some cases, the expense ratio of an ETF can be lower, in some cases significantly lower, than a comparable mutual fund. So yeah, you pay some fees when you buy it. You have a brokerage fee. You have the bid-ask spread. Maybe you're paying a slight premium. But if you're getting a significantly lower expense ratio and you're a long-term investor, you could eventually end up doing much better in terms of costs with an ETF, right? That's one. The other thing is ETFs can be more tax efficient. So if you're investing in a taxable account, ETFs can be a little more efficient. And to understand why, imagine you with a mutual fund, you want to sell your shares. As I've mentioned earlier, you sell to the mutual fund company, right? Well, the mutual fund company may not have cash sitting around to pay you. So they have to generate that cash. How do they do that? Well, they sell some of the securities owned by that mutual fund, right? Stocks or bonds. And that can trigger capital gains, which eventually get pushed down to all of the shareholders of that mutual fund. Now, mutual fund managers do what they can to minimize that, and they can, if they sell some stocks at a gain, maybe they offset that by selling some stocks at a loss, right? So they do have ways to try to minimize the capital gains hit on the shareholders. But sometimes it's unavoidable. And so as more and more shareholders want to sell, it can force the mutual fund company to sell some of the underlying securities that may not otherwise want to do, and that can trigger some capital gains. With an ETF, as we've talked, you're not selling back to the ETF company, right? You're selling to another investor, and so you don't have the same issue with an ETF. And so ETFs can be more tax efficient. Now, with all of that, I go back to what I originally said, and that is I think for most investors, particularly ones that invest in low-cost index funds like what Vanguard offers, I don't generally see an advantage to an ETF. Why? Well, one is that particularly if you're investing in the Admiral share classes at Vanguard, which generally require $10,000 or more, your expense ratio is at least all the funds that I'm aware of, identical to the ETF. So for the total stock market index fund, I think Admiral shares, I believe the cost is expense ratio is 5 basis points. And it's the same for the ETF. Now, if you don't have $10,000 to invest at the moment, your costs go up slightly. I want to say it's 17 basis points for an investor class of shares, which is what you'd have to to buy if you had less than $10,000 to invest. But hopefully over time, your balance in that fund will go above $10,000 anyway, and you could transfer them over to Admiral shares, and you'd have your 5% or 5 basis points in expense ratio. So with Vanguard, you don't really have that big advantage with the expense ratios of ETFs over mutual funds. And as I said, with Admiral shares, I think they're identical. At least all of the funds that I'm familiar with, they're identical. Now, with Vanguard, you also don't have, if I want to buy an ETF, a Vanguard ETF, I don't have to pay a brokerage fee, but I still have to deal with the bid-ask spread. If it's selling at a premium over its net asset value, then I've got to pay that premium. And so I think for most investors, all of that's just not worth it. I think the mutual funds that Vanguard offers are perfectly fine. I think they're extremely tax efficient. Even if you're investing in a taxable account, I see very little difference between the mutual funds at Vanguard and the ETFs. Again, at least the ones I invest in. And so there's just generally no reason to have to mess with the complexities of an ETF and opening up a brokerage account at Vanguard. I just have not found a need for it. Now, there are some exceptions to that, and occasionally, particularly once you get beyond sort of your basic core portfolio, if you want to invest in certain somewhat unique asset classes, I've found ETFs to be helpful. And the one example in my portfolio is DBC, which is a PowerShares commodities ETF. And I invested in that because I wanted a small exposure to commodities, and I didn't like what Vanguard offered. Vanguard does have a commodities fund, but it invests in companies that have exposure to commodity prices rather than investing in commodity contracts, which gives you a more direct exposure to the commodities market. And so DBC gave me that kind of exposure. So I have, in my Vanguard brokerage account, I own shares of DBC for my commodities exposure. And I think for many investors, they don't even worry about having some, say, 3 to 5% invested in commodities, which I think is fine if that's the choice you've made. You wouldn't even have to worry about this. But in my case, I wanted that exposure, and I found an exchange-traded fund, an ETF, to be the best option for me for that asset class. But pretty much for everything else, I own mutual funds. So I think, again, for most investors, you just don't need to worry about ETFs. Again, if you're investing in that low-cost index funds like Vanguard. Now, if you start to get into actively managed mutual funds, which I generally avoid, you can see some differences and sometimes some significant cost and tax differences in ETFs. And so the sort of the final thing I want to mention on this is how you can figure out what the cost differences are and what the tax efficiency differences are. And it's really easy to do. All you have to do is go to Morningstar. If you go to Morningstar and type in a ticker symbol of an ETF or mutual fund, and I'm going to use as an example VOO, which is the ticker for the Vanguard S&P 500 ETF. It brings up a page that has some basic information about this ETF. And we've talked about Morningstar during the 31-Day Money Challenge, so you may be familiar with it. But for example, it will tell you whether the ETF is selling at a premium or a discount. In this case, it's selling at a slight premium, 0.02%, not significant, but it's a premium. It also tells you what the bid-ask spread is. In this case, it's also very small, 0.02%, and I would expect that to be the case because, as you might imagine, a Vanguard S&P 500 ETF is going to be a very active fund, and it does show you the average volume, daily volume in Morningstar. In this case, it's over 1 million shares a day. And so it gives you this information, and you can easily compare it with say a comparable mutual fund. So if you're really whatever you're going to invest in, I mean, I've kind of walked through Vanguard, but for your own sake, whatever you're going to invest in, if you're considering an ETF, pull up the ETF and the comparable mutual fund in Morningstar. You can very quickly see what the expense ratios are for both, for the ETF, whether it's selling at a premium or a discount and how much. the spread between the bid and ask price, and you can assess this for yourself, which I think is critical to do. And so that's my view on ETFs and mutual funds. It gives you a sense as to the difference. As you can tell, I think if you're not used to buying and selling stocks, particularly in a brokerage account, the idea of ETFs can just seem like it's more work than it's worth. And generally, I think that's true, again, if you're that low-cost index fund investor like I am, where I have most of my money in those sorts of funds at Vanguard, and I have some at Fidelity. But again, you just need to do your homework to make sure you know in your specific circumstances what the better option is, because sometimes I think the ETF is the better choice. Now, before I bring this episode to a close, that kind of gives you at a high level the difference between mutual funds and ETFs. As I said, when you go to the show notes, you'll be able to see the article I've written that's got a little more detail. I've got screenshots from Vanguard. I link to a lot of different information. I will add that an excellent book on ETFs by Rick Ferry, who I had on the show some time ago, is the ETF book. I've read it. I highly recommend it if you want to know more about ETFs. It's an excellent book. The last thing I want to mention, though, kind of moving away from mutual funds versus ETFs, is the market. You know, when we were doing the 31-day money challenge through January, the market was taking a beating. And I was trying to encourage people, hey, you know, stick in there, have your asset allocation plan, stick with it. Sometimes the market goes down, and that's just the way it goes. But we're long-term investors here. We're not going to flee the market out of fear because it happens to go down 2 or 3 or 4% or 20% for that matter. Well, January was a rough month, but knock on wood, so far February has turned around quite nicely. Of course, you know, I try not to get too excited when the market goes up for a couple of reasons. One is we know it can go down just as quickly, and two, as the market goes up, it makes buying new investments more expensive, and that's no fun. But I hope as you kind of, as we work through various podcasts on investing and as we watch the market, you'll see, yeah, some days it goes up, some days it goes down, some months it goes up or down. And that's just the nature of the beast. And I hope you've defined what your asset allocation plan is, what's best for you. And I hope you're sticking with it, whether the market's going down and you're perhaps a little fearful, or the market's going up and maybe you start to get a little greedy and want to move everything to stocks. I hope you stick with your asset allocation plan. I know I have. As always, if you have any questions about today's podcast, shoot me an email. And I guess this is time for me to cue up that music. There we go. Shoot me an email at dr@doughroller.net. I love to get the email. I read and respond to every single one. If you've sent me an email and you haven't gotten a response from me, I don't know, maybe the email monster ate the email. Ping me back. Some people have had to do that when some emails have slipped through the cracks, but I do read them all and respond to every email. You can get the show notes to this podcast at DoughRoller.net/podcast 39. Let me make sure I got that right. Yep, it's going to be the 39th episode. And as I said, it's a detailed article with a lot of links that can help you dive into ETFs in a little more detail. You can also subscribe to the show. Just go to DoughRoller.net/iTunes. And if you haven't, I'd be grateful if you'd leave a review of the show on iTunes. That helps out a lot. Love to hear your comments. And so remember, until next time, the best thing money can buy is financial freedom.